Good morning, and thank you for joining us for this episode of SBB University, where we are going to be discussing smart money when you're planning for retirement. We have a dynamic group of panelists that are here with us today. I'm really excited to introduce Brian Bronsther, who is with the Dorcey Law Firm. How are you this morning, Brian?
I'm marvelous, absolutely marvelous.
Tell us a little bit about yourself and your background.
Sure. I went to undergraduate at Lehigh University in Bethlehem, Pennsylvania. Ended up going to law school at University of Miami, go Canes. And then ended up practicing in Fort Lauderdale for a couple of years, doing estate work primarily. And then moved up to Manhattan and worked in Manhattan for about 4 or 5 years as an estate planning and real estate attorney. Ended up opening up my own practice in upstate New York for 27 years. When my wife had finally had it, she had said the winters were way too cold, figure out a way to get down to Florida. And I was fortunate enough to be introduced to the Dorcey Law Firm, where I've been able to develop the elder law program for the last 3 years. So here
What
I am.
an impressive resume. We're glad your wife dragged you down here.
My pleasure to be here. It's paradise, is what I've been told, and it's true.
It certainly is. It certainly is. All right. So next we have Miss Alanna Morey, who is with Siena Wealth Advisors. How are you this morning, Alanna?
Good, Amanda. I'm doing great. Thanks. How are you?
Good. Thank you. Tell us about yourself. I know that you got some new certifications recently. I'm very excited about. So tell us a little bit about it. Yes.
Thanks, Amanda. So yeah, recently I'm a private wealth advisor with Siena Wealth Advisory Group. So that was my recent new designation I received with the Ameriprise. I'm also a certified financial planner practitioner, and I am an accredited portfolio management advisor as well. So some letters after my name that I'm proud of.
Yes.
So I've been with Siena Wealth Advisory Group now for over 10 years. And I am from New York myself.
Yes.
Brian, I grew up in Rochester, New York. So I'm from upstate New York as well. And I've been down in Naples now for just over 3.5 years. I instead dragged my fiance down to Naples. So similar, but at Siena Wealth Advisory Group, we focus on delivering comprehensive, personalized advice to our clients through financial planning. So what I really love about what I do is getting to know each of my clients. Everyone's situation is unique, and getting to know them, their family dynamics, and then together we put together a plan, and I love doing that. So I'm happy to be here today. Thanks, Amanda.
Absolutely. Thank you so much. And last but certainly not least, we have Mr. David Edel, who is with Mutual of Omaha. How are you this morning, David?
A little bit about my background: born and raised in Minnesota, spent then 18 years in California as general manager for Marriott Corporation. I've been a full-time Naples resident for 23 years and full-time reverse mortgage loan officer since 2006. I was with Bank of America for a number of those years, and Wells Fargo before they got out of the business, for Collier County and Lee County. And now I'm with Mutual of Omaha, which is a fantastic company, 112 years old, owned by the policy holders, 6.5 million policy holders. They're the largest Medicare supplement provider in the country. And many people remember in my age bracket, Wild Kingdom, the show, and that usually brings a smile to everybody's faces. It was on for 26 years, and Marlon Perkins. And whenever I mention that in a presentation, everybody just, has fond memories of that. So.
Very good. Well, we're appreciative of all of your partnerships with Seniors Blue Book and the community education that you're bringing to our viewers today. I look forward to David going through and debunking the myths about reverse mortgages. I think that a lot of folks don't realize that that's a key element in planning for your retirement. All right, we're going to start with Brian, because the key to planning a successful future with Alanna as well is, tell us exactly what documents are most essential to have in place when you're planning for retirement.
we consider there to be five documents that are essential after the age of 18. The first is a power of attorney. Not all powers of attorney are created equally. You can go to different attorneys throughout the Southwest Florida, throughout all of Florida, and see a variety of different types. What you really need is a comprehensive power of attorney, which covers all different aspects of your life so that your agent can truly just step into your shoes as if they were acting for you, doing everything that you can do. The second document would be a designation of healthcare surrogate. That's for someone to make your healthcare decisions. Technically, it is effective immediately, but between you and the doctor is always going to rely on you first, as long as they comprehend what you're saying and you can communicate what you want to say. The doctor is going to rely on you to make your healthcare decisions. It's only when you can't that the surrogate will probably be able to step in under those circumstances. The third document, which is essential to carrying on your life, is to be able to get your medical records. And if you are unable to get your medical records, federal law says that unless you signed a waiver of HIPAA, we're not going to release those medical records.
Right.
So that is a waiver of HIPAA that should be signed, appointing certain individuals to be able to get your medical records in case you cannot. Fourth document is a living will. That's truly an expression of your intent as to what you want done in the event you're in a terminal, irreversible, no hope of recovery situation, so that you can decide, or your agent can decide, as to what whether you want heroic measures or what type of services you want, procedures you want in the event you're in a terminal condition. Those are the five supportive documents that I recommend.
And there's a big misconception between the difference of a living will and a DNR. So just briefly discuss the differences for our viewers today.
Okay, so the DNR is typically going to be put on your refrigerator door, so that
yellow paper.
So that when an emergency occurs and the paramedics come to your home, they're going to see that right there and then. The living will is more to the extent that you have a terminal disease. There's no hope of recovery. 2 doctors have said that there is little likelihood of recovery, and now you're really expressing your intent as to what type of procedures you would want in the event of under those conditions. So, for example, if you had stage 4 cancer, would you really want to have invasive procedures to or a ventilator or a blood transfusion if it wasn't going to cure that disease?
Right.
You may not want that. That's the really big difference. Okay,
perfect. Thank you so much. All right, Alanna, we're going to move on to you now. What are your insurance needs as you retire? Because there's so many different products that are out there. So talk to us about some of the most important ones that you look at when you're planning for retirement.
Yeah, absolutely. Well, of course, you're going to need regular health insurance, and depending on when you retire, likely will be Medicare, but it might be something else. You might have to pay yourself if you retire before 65. Other types of insurance that you may need in retirement could be long-term care or nursing home care insurance, which I know we'll talk a little bit more about, but this is insurance that if you qualify, if you can afford it, if it makes sense for your life, it would help to pay for care once you qualify for the care, whether it be home care or nursing home care. And then of course, there's also life insurance too. So, generally speaking, very generally speaking, the older you are, the less insurance you need, right? And that's because maybe you bought a lot of insurance when your kids were young, or you had a large mortgage on your home, and now the mortgage is paid off, the kids have kids of their own. So you might not need as much insurance, but you do need to review your personal situation to determine if you should still keep the level of insurance you have, if you want more. For example, if you're married, would your spouse have enough money should you pass away first? Is something that we always look at. So for example, if you have a pension, will your pension continue if you pass away, or will it stop upon your death? And will that be okay for your spouse? And of course, do you want to leave anything for your children? You know, some people, that's really important to them. They want to leave something for their kids, other heirs, charity at the end of life. So there's a lot of considerations when we look at insurance. And really, that's what we sit down with you to determine what's important to you, again, what you can afford and what makes sense for your lifestyle.
Yeah, and there's a combination now, like hybrid plans of
Yes.
long-term care and life. And do you want to just touch on that a little bit?
Yeah. You know, the traditional long-term care insurance, one can be very expensive. And again, I think a lot of people, from what I hear, can be hesitant sometimes to purchase a policy because it is, if you don't use it, you lose it, you know, so you could pay these premiums for so many years. And then in the end, you might not need it, which, hey, you don't need nursing home care, long-term care, great. But you still did pay for all of those years, you know, essentially, quote, for nothing. So now there are policies, for example, that are more hybrid type policies, ones that may offer a long-term care benefit and life insurance benefit together. So, you know, you buy a life insurance policy maybe for $500,000. If you need long-term care, depending on the policy, you could use up to $500,000 of the death benefit or up to a portion on your care, and anything left over would go to your beneficiaries. So there's a lot of options now and more coming out all the time. So it's not just the traditional policies anymore that we look at.
Yeah, and I know that it's best to do the purchasing of long-term care insurance when you're younger. But is there a cutoff? Is there an age when you say, like, it's too late, you can't do this anymore?
I mean, is there a cutoff age? Not necessarily, but with all insurance, right? The older you are, the more expensive it's going to be. One, because of our age, but also things happen as we get older. We're not as healthy as we once were. So it just becomes ridiculously expensive, you know, where it would not make sense the older you get. But, you know, I see policies that we look at for people in their 50s, 60s. I mean, I have done one for someone in their early 70s before. So it's always something that you can speak to your financial advisor about. They can pull quotes for you, you know, depending on your, again, health situation, also your financial situation. Maybe it would make sense, but it can't hurt to look at it and have a conversation about it. So you can decide what you would want to do if and when you need care.
Right. Perfect. Thank you so much. All right, David, let's talk about reverse mortgages. A lot of people hear that word and they're fearful of it. You know, it has a bad reputation from the past. Talk to us about exactly what a reverse mortgage is and how you qualify for one.
Okay, great. A reverse mortgage is an FHA mortgage that doesn't have any kind of a payment schedule except for the death of the borrower or the sale of the home. So it's a way to convert equity, a portion of the value of the home, into cash without any obligation on the part of the homeowner to ever make a mortgage payment.
Right.
So nothing changes with the title. The owners can sell the home whenever they want and certainly bequeath it to their heirs when they pass away. So they're still responsible for taxes and insurance and HOA dues and you know, overall maintenance of the property. So that's basically what it is. I mean, it's just a mortgage. You know, it's not as big of a deal as as some think. So as far as qualifying, people need to be for the FHA mortgage, which is about 98% of the mortgages that are written today. People need to be, the youngest borrower needs to be 62 years old and needs to be the primary residence. And the value, as far as the percentage that they get, is between 50 and 75%. That depends on the age of the youngest borrower and the current interest rate. The money that they get, so it's turning this equity, which is basically it's an intangible benefit. It really doesn't have any real value. It's only on paper until it's separated from the home.
Right.
And so it turns it into a tangible benefit of tax-free cash. And the cash can be taken in a number of ways. It can be, if there a lump sum is needed, that's fine. You can take a monthly income, which is guaranteed for the life. It's like an annuity. As long as one of the two people are living in the home, that's guaranteed. Or it can be put into a line of credit, which is turning out to be a cornerstone for a lot of folks as far as for their retirement planning. You know, in that it's continually growing. It isn't a line of credit that is static like a home equity line. It grows every single month at right now at about 3%.
Wow.
So,
yeah, I see it as a really big benefit for people that want to make improvements to their homes so they can age in place. That's a big thing when you're making modifications. So I think that a lot of folks that are planning, you know, to live in their home for the rest of their lives really need to look at the benefits of a reverse mortgage.
yeah, it's freeing up, you know, it's converting that equity into cash for, you know, medical bills or home improvements or, you know, travel or pay off credit cards, medical bills, long-term care insurance, in-home care. I mean, it's a wonderful, very fulfilling job for me because it's like I'm sort of giving away money. As far as the negative part of why it has some connotations, you know, back in the day, from reverse mortgages started in 1961. So that's a surprise to a lot of folks. But from 61 to 88, it was in private hands before the government got involved. The FHA, it became an FHA supported product. And so there's misconceptions. One definitely main misconception is that the bank takes your house when you die.
Right.
So I'm still kind of having to clarify that. And I guess the only other thing is, as far as a negative, you know, people complain about the cost. So there is the upfront closing cost. So there is an extra 2% of the home's value as part of the closing cost. But that insurance premium for FHA is precisely what guarantees a monthly income for the rest of their lives. For example, it guarantees the luxury of never having to make a mortgage payment. I mean, you can imagine, you know, a young couple going in to buy a house in a bank, and then the banker says at the end, well, we have this other option. And this other option is if you allow us to put 2% on the back of this loan, you never have to make a payment. You know, probably.
Yeah, right.
Where do I sign? Yeah. So
yeah, I think that the negative connotation back in the day too was people are so used to making their HOA and their insurance and their tax payments in their mortgage that when you take that away, oh, you don't have a mortgage anymore, but you still have this other payment. Either it didn't click and it didn't register, or they didn't make their payments, and that's how they were losing their homes.
Yeah, like I said, taxes and insurance, they still own their home. So all those responsibilities that with home ownership stays with it. You know?
Right, exactly. All right, Brian, we're going to bounce back down to you. Now, there are several different kinds of trusts that are out there. And one of them for pre-planning for those folks that may be on the cuff of, like, you know, you might be able to afford, you know, some type of assisted living when you get older, but you're right on that verge of maybe you might need Medicaid. So talk to us about the different types of trusts that are out there and how to pre-plan if you do need that trust for Medicaid.
Okay. So there are really, in Florida, there really are two types of trusts you have to be concerned about in order to qualify for Medicaid. And in order to qualify for Medicaid, you have to qualify from an income standpoint and from an asset standpoint. From an income standpoint, if your income is above a certain level and that level changes each and every year, if you have excess income, it's problematic. And the state of Florida has said that even if you're $1 over that allowable amount, and this year it's $2,382, it'll be changing again in January. But if you were $1 over, that would mean that you're not eligible. However, Florida has said that if you take your excess money, your money above the base amount, that $2,382 for this year, and you fund that into a trust, we're going to allow you to be eligible. And that type of trust is called a qualified income trust. And doesn't have to be created and funded until 1 month before you apply for Medicaid. But as long as you have that trust and every month you fund it in with the excess income, you will be eligible on an income base. Now, you also have to qualify from an asset base. And one of the things that we look at is what type of trust can you use to protect assets,
Right.
so that they're there and available for different options. And one of those, I call it, is an asset protection trust. And the asset protection trust has a trustee, which really shouldn't be you, okay? And has lifetime beneficiaries, which really should not be you either. And if you put your assets into this type of trust, and they're in there for more than 60 months, so we're looking at proactive planning. If it's in there for more than 60 months, then those assets that you put into that trust will not be considered available resources for Medicaid purposes.
Okay.
This is an irrevocable trust, so you really can't change it. There are some ways to get around that. And there's some strategies you can use by preparing the trust accordingly that will allow you to give you some flexibility, such as being able to change the death beneficiaries through your last will and testament. But this trust is an irrevocable trust, and you can receive the income out of it, but you can't receive the principal out of it. And that's really where the protection comes in, because since you can't receive the principal and it's been in there for 60 months or longer, then the assets are not considered part of a resource for Medicaid purposes.
Interesting. And the beneficiary that you assign can still make your payments on your bills and things like that through this trust?
So the way it can work is the trustee can pull money out, okay, give it to a lifetime beneficiary, okay, and then that lifetime beneficiary could spend the money on you if you're so inclined.
Okay.
So a lot of times we'll put money into this trust, money that we're not going to be using on a daily basis, but all of a sudden a new roof has to be put on. And if you've looked at the cost for these tile roofs, they're kind of expensive.
Very.
So if you've got a bunch of money in this trust and you want to pull it out, the trustee can pull it out, give it to a lifetime beneficiary. The lifetime beneficiary could then spend it on mom and dad. And typically we'll see the children as the trustee and the children as the lifetime beneficiaries.
That makes sense. Absolutely. Okay. Now, as far as a revocable trust, what would be the benefit in that?
Okay. So the best way to describe what a revocable trust is I want everyone to go back in history and remember what that old-fashioned piggy bank.
Yes.
That old-fashioned piggy bank used to take a hammer and crack it open if you wanted to open it up. Well, they got real fancy and they set up a piggy bank with a cork in the bottom of it, right? And that cork, if you pulled the cork out, you could get the money out by shaking it really hard. So a revocable trust is that piggy bank with a set of instructions, but you control the cork. So you can pull the money out anytime you want. One of the great benefits of this revocable trust is that it avoids probate. Okay, probate's the process by which the last will and testament is submitted to the court. The personal representative or the executor, in other terms, is appointed to distribute the assets of the individual. The revocable trust is a will substitute. It works exactly the same way, except for the trustee distributes the assets upon you passing away. And while the revocable trust, since it avoids probate, Medicaid has no right to come after those assets that are in the revocable trust. So, for example, we'll sometimes put a house in there because a house is an exempt asset. But if you sell that house, it's money, and that money is now attachable by Medicaid. So it doesn't protect assets, but it avoids probate.
Okay, perfect. Thank you. All right, Alanna, now you have this certification as a certified financial planner. Tell us a little bit about how that distinguishes you from other financial planners out there.
Sure. Thanks, Amanda. So a CFP, it's a type of financial advisor like me who's passed a certification for financial planning knowledge. And you need to have several years of experience related to financial planning to even sit for the exam. You have to pass the CFP exam, and you also have to pass all of the education requirements, which take about 9 months. And it covers things like education and retirement planning, tax planning, estate planning. So it covers a lot, and CFPs must also adhere to strict ethical standards. We have a code of conduct board, and we're also held to a fiduciary standard, meaning we're obligated to act in the best interests of our clients. So, and we're held to that as well.
Yes, it's a special certification. I've heard the test is incredibly hard. So congratulations.
It was, thank you. Thank you. Yes, it was hard, but I learned a ton. Honestly, I learned a lot, and I kind of enjoyed it, I have to say. So it was great.
Good. Well, talk to us about annuities, because that's another one of those financial plans that I think has gotten a bad rap. So let's debunk the theory on
Definitely
that bad word.
Yeah, annuities get a bad rap for sure. And sometimes they are not good for a client. You know, like I always say, I'm sure I'm going to say this at least 20 times, Amanda, everyone's situation is different. So it's not one size fits all for anything that any of us do. But an annuity, pretty much what it is, it's actually an insurance product, but it offers tax deferred growth on your investments. So you put money into an annuity, you can name beneficiaries to that annuity, and then it grows tax deferred until you withdraw the money. Now, a lot of people also think of annuities traditionally as you give up that principal in exchange for payments, but that's not always the case depending on which annuity you select. So annuities, I think, get a pretty bad rap for a few reasons. And mainly it has to do with fees. Number one, you know, annuities, have surrender charges. So if you put money in today, most annuities will have several years that you can't take the money out without paying a fee. So they're not completely liquid. So you can't put too much money into an annuity because you need liquidity. Most people need liquidity. In addition to that, there's internal expenses on these that are generally very high. And most people just don't understand what the fees are and what they're even paying for. So they can be very confusing. But again, depending on your situation, an annuity might make sense. You know, today, like we were talking about, you know, the long-term care insurance, there's not just the traditional long-term care anymore. There's a lot of different types of annuities, for example, there are some that guarantee a certain percentage of income without you giving up your principal. There's annuities that offer downside protection on the market. So like all investments, it's not one size fits all, but again, work with your advisor, because for your situation, maybe it's appropriate. It might be appropriate for you.
Yeah, it sounds like a lot of these, like long-term care insurance annuities, they're all creating these hybrid programs that work really well. So there is like a perfect solution out there for each individual person. And like you said, it's very personalized. So with that special like designation that you have, I think it's amazing that you're able to help your clients figure out exactly which matchmaking way they need to go. So to have that perfect investment. All right, David, we're going to bounce back up to you. Now, we talked about the qualifications that you have to have in order to qualify for a reverse mortgage. Interest rates are at an all-time low. So talk to us a little bit about, you know, what the interest rates are now and what the process is for getting qualified. I know you gave a little description of that, but kind of elaborate a little on that for me.
Another misunderstanding with reverse mortgages is that the interest is higher than forward mortgages, which is not the case. The reverse mortgages that I have been writing recently for the last number of months have been, you know, in the 2%, just over 2% to up to 2.5% and so forth. So they are, you know, the timing is an incredible time right now with high values and low interest rates. The lower the interest rate, the more higher percentage of the appraised value that someone gets. And there's basically four steps to the process. There's a counseling session that's required. We provide the homeowner with a list of HUD certified counselors. So they go through that over the phone. So that's the first step. And then the application process, and then the appraisal, and then about 6 weeks to get to closing. as the fourth step. And there's a 3-day right of rescission if they want to change their mind. And then on the fourth day, it funds. If they have a mortgage, we pay that off. So that some people do get a reverse mortgage simply for that reason, just to get rid of their current mortgage payment.
Sure.
And then if they don't have a mortgage, they decide how they want to take the money. So some folks, more and more affluent folks are taking it to extend the longevity of their portfolio.
Sure.
There's been studies conducted where you pull on when your portfolio is in down years. If you don't have to sell that depreciated asset, you can pull from your line of credit and let that grow. I mean, the difference is just amazing after 15 years if for that situation. So that's good. And another thing, if I might mention before we forget, is the ability to purchase a home.
You beat me to it. I was going to make sure you mentioned that because that's another theory that people definitely need to debunk. They think that you can't. So tell us about that for sure.
Yeah, it's great. I mean, anybody who's 62, I mean, it just makes so much sense to buy their home with a reverse mortgage. They need to bring about 50% of the purchase price to the table, and the reverse mortgage finances the other 50%, and they take possession of the house and never have a mortgage payment.
Yeah.
So the only other alternatives are a full cash purchase, in which case they're departing with 100% cash instead of 50%, or being locked into payments for probably the rest of their lives by getting a traditional mortgage. So it's called H for P, HECM for purchase, is a tremendous, and there's more and more people and realtors coming around to realizing it's kind of been a slow process for people to find out that that's a possibility.
Absolutely. Absolutely. I'm glad you brought that up. I was going to add, that was going to be my last question. So you wrapped it up just perfectly. Thank you, David. All right, guys, if you have additional questions for our panelists, please click the chat above and their contact information will be right there for you. Ladies and gentlemen, we appreciate you so much for coming on the show this morning. Appreciate your time and your partnership with Seniors Blue Book.